Hello and welcome to Enrich Academy. This is Nancy. Today we're going to discuss about the investment strategies to overcome inflation. Now, have you ever saved up from your income first and then thought about expenses? Well, the truth is most of us spend first and then think about savings with whatever is left, right? We should always prioritize investment before spending. Food, shelter, and water are the basic survival needs. Apart from these, we also require savings and investment. Now, many of us may think that our savings are our investment, but you need to understand that savings is just an amount that you have in your bank account or the amount that you keep at home or in hand. Whereas investment is your assets like your house, the stocks you buy, gold, the bond, etc. Let's look at stock market. The first thing to do is to get rid of the fear of stock market. As Warren Buffett said, if you cannot control your emotions, you cannot control your money. So it's important to get rid of your fear. Stock market is an investment tool. There are two kinds of analysis to understand stock market in a simple way. There is the fundamental and the technical. The fundamental deals with the basics of stock market, whereas the technical is the advanced level which you need to gain knowledge of after you have fairly understood the basics. Now, our mindset would be how to earn money, the ways to earn money, and so on. But we may not have the right plan or strategy for earning money. You need to plan it now. This is the moment you're going to plan for your future in the right way. Do not follow anyone. Plan for your life and your future based on your income. I'm sure you're working very hard to earn for yourself and your family, right? But now is the time to work smart. Start researching online. Think how you can multiply your income. It's very important to choose your investment strategy. If you're not planning to invest, then you are definitely missing a golden opportunity. If you play safe all your life, it's meaningless. Life is all about challenges, overcoming those challenges, and in the process, taking risks whenever necessary. So if you think you're safe just because you have cash in hand, that's a big mistake. Go ahead and invest it for yourselves and your future generation. Consistent savings will help your life, whereas an investment will help your future and your generation. That's when you can call yourself successful in investment. Remember, the money that you may get may not be enough to accomplish your goals in life. The money that is inactive in your bank account is wasted opportunity. For instance, in order to save on tax, you may buy life insurance policies or invest in risky stocks or purchase unnecessary things. These are detrimental habits which merely lead to financial instability and loss. Now, long-term goals can be achieved only through investment. Remember, investment appreciates the value of money, while savings depreciates the value of money. The probability of high returns is much more in investments than in savings. So investment is the only way to beat inflation. As you all know that inflation decreases the value of money. Now let me explain inflation with the help of an example. Let's say you have 10,000 rupees in your savings account that pays a 5% interest rate. Now, after a year, you will have 10,500 rupees in your account. But if the rate of inflation is at 10%, you would need 11,000 rupees to have the same buying power that you started with. Here you've gained 500 rupees, but you've lost your buying power. The point to note is, if your savings don't grow at the same rate as inflation, you will lose money. So inflation minimizes your savings. As inflation goes up, your standard of living comes down if you depend on your savings alone. Hence, if you start investing in the stocks of a company that grows well, it is equivalent to starting your own business because you will anyway receive the bonus or dividends from the company you have invested in. Any business would earn profits and incur a loss at some point, but you need to wait patiently for the return on investment in the long term. The bottom line is that inflation has a tendency to split a consumer's buying power sooner or later. Fortunately, there are means to protect the buying power of your savings. At this juncture, stock market is the best investment strategy that you can adopt because stock market can give you high returns in the future. Now let's have a look at the value of Indian rupees and the inflation rate since 1960. The chart here gives you an approximate of the inflation rate and the value after every 10 years. From 1960 to 1970, 70 to 80, and finally 2010 to 2020. So this means that 10,000 rupees in 1960, for example, is equivalent to 17,478 rupees in 1970. Likewise, if you look at 2000 to 2010, what was 10,000 in 2000 became 18,089 in 2010. In 2020, the same amount is valued at 19,526. Approximately, there has been a depreciation from 100 to 140% every 10 years. So if you had 10,000 in your account in 2010, the value of the same amount in 2020 is just about 400 rupees due to inflation. Likewise, from 2000 to 2010, the value was 1,900 rupees. So this is what happens if you keep your money idle in the bank account. Now there are several websites that give us an idea of the value of the Indian rupees as compared to the dollars. Say for example, Inflation Tool, as you can see on the screen. You can see the comparison between 1958 and 2020 here. There's also a calculator where you can calculate the value. You must diversify your investment. You could invest in land, or as we suggest, you could invest in stock market as there is liquidity in stocks. A drawback in purchasing land is you may not be able to sell it immediately. But stocks can be sold whenever you want to as there's liquidity. As inflation goes up, by and large, the cost of living increases. For instance, 10 years back, the cost of milk was rupees 10. Today, the cost of milk varies from 30 to 50 rupees depending on the type of milk, correct? Likewise, the price has risen for essential products like rice, pulses, petrol, etc. And this has ultimately caused a massive blow on the monthly budget. This clearly shows that we have to pay more for the same products that used to be of less price 10 years back. Hence, inflation is directly related to buying power. Say for instance, you earn 30,000 rupees and the inflation rate is 10%. The amount you earned will be worth just rupees 27,000. Let's put it this way. If your salary hike is 10% every year, in the next 5 years, it should have reached 50% hike. If not, you are ultimately in debt as you have no surplus amount in hand, which leads to a cut in your purchasing power. Instead, if you spend on investment, you can meet your expenses with the returns that you gain from your investment. Now let me show you how stock markets can give you returns despite inflation. There have been instances of stocks which grew exponentially. For example, an investment of just 10,000 grew to 1.5 crore in 10 years. Some companies whose share prices have grown over 5,000% in the last 10 years include TTK Prestige, Havells India, VIP Industries, Whirlpool of India, IndusInd Bank, etc. However, you must be careful as there are companies that have plunged to 90% in the last 10 years. For example, Reliance Communication, Videocon, Unitech, Religare, and so on. And we can also give you several examples about investors who invested with a small amount and gained really high returns. There are several websites wherein you can research. For example, Economic Times is a good website. And if you look here, Infosys in 10,000 delivered 2,973 times return. Also, another article says 10,000 investment turned to 1.5 crore in 10 years. There is a lesson about patience and conviction that we should learn from an investor who invested 10,000 rupees in Wipro in 1980. He had invested in 100 shares at a face value of rupees 100, which is 10,000. Eventually, his shares increased as the company kept declaring bonus every year and paid out dividends. Cumulatively, he received rupees 118 crores as dividends in almost 30 years span. Thus, by making an initial investment of just 10,000, he gained almost 500 crores. Likewise, there are several such examples that we can provide you to help you understand the importance of investment at the right time. The stock or products you invest in must create a demand in the future. Hence, it is very important to maintain the momentum of inflation when you invest. Your investments must produce returns which are higher than the inflation rate if you want to overcome inflation rates. Keep in mind, your money loses value due to inflation if you do not invest it. Remember, it is vital to analyze the future growth of companies with the help of an expert financial analyst before investing in any stocks. Never buy stocks or trade without good knowledge of the market or proper guidance from an expert analyst. To know more about stock market, you can also visit our website and click Research and then click Knowledge Center. You have two options here. You can see Fundamental Analysis and Technical Analysis, and click Fundamental Analysis and you can see the different options over here: Stock Trading Basics, Indian Trading Exchanges, and so on. To know more about stock market, share, like and subscribe our YouTube channel. This is Nancy signing off from Enrich Financial Group. Thank you.